Luke, our main focus point today is about stablecoins. And first, I think we need to address the recent bill that just passed Congress called the Genius Act. First off, what do you know about the Genius Act? And can you tell the listeners of why it's called the Genius Act?
Well, it's called the Genius Act because it's the Government Encouraging New Innovations and Utilizing Science Act. So Genius is an acronym. If you recall back in the day, this was Trump 1, right? He calls himself a stable genius. There's a lot of conjecture about whether or not that is also the reason why they've named it that bill. That's never been fully confirmed, though. The president did make a nod to it when he signed the bill, saying that they named it after him. So make of that what you will. But essentially, at a high level, what the Genius Act attempts to do is create a regulatory framework by which stablecoins can be regulated and issued in the United States. Now, we can dive into all the positives and negatives of those things, and specifically of this bill, but there's a whole bunch of reasons that the administration thinks it'll be beneficial, a whole bunch of reasons that it might not be.
Now, stablecoins are aimed to be a alternative to cryptocurrencies that are typically very volatile, and trying to turn them into, or cryptocurrencies in general, into mediums of exchange, as opposed to what the vast majority of the industry has turned into so far, which is more of elements of speculation and just trying to, hodl and hope the number goes up, right? Mm-hmm. Now, stablecoins in general are pegged to some sort of external asset. And we'll talk a little about what they can be. But the primary one is going to be pegged to the US dollar or dollar assets. So it could be actual US dollars, or it can be treasuries, for example, that are denominated in dollars, that are very safe, etc. And, the end goal here is to say, okay, while you might accept Bitcoin, for example, as a vendor, as a store, you when you do that, you open yourself up to currency risk, right? The fluctuations of that currency, which can be good, can be bad, but ultimately most companies don't want that exposure, and so they want the convenience potentially of a stable coin or a cryptocurrency. However, they don't want that currency risk. And so the idea here is to turn cryptocurrency more into a medium of exchange. What do you think of that concept, Luke? Do you think that holds water, or do you think that is an excuse for just expanding the types of crypto assets that are out there?
I could talk for hours about this. But here's my primary thinking on the payment method thing. And that is, you see it with Walmart, and one other company said they wanted to issue a stable coin because the businesses themselves are incentivized to do what? Move away from having to pay processing fees to Visa, MasterCard, American Express, whomever they use. And so they want to be able to do something that makes it cheaper for them. But in order for a transaction to happen, right, there are two parties to a transaction. In this case, there's a buyer and there's a seller. And so the buyer, who is using their Visa, their MasterCard, their American Express, is incentivized to keep using those things through reward programs, right? That is one of the reasons why people use credit cards to rack up points. Hopefully they're paying off those credit cards. But essentially, if you really want to move from the payment clearance system we have today towards stablecoins, you have to incentivize not the sellers, who are very much incentivized to not pay fees, but the buyers. And I just don't see anything in here or any real proposal that suggests that is feasible, at least in the near term. And that's just on that side. There's a whole other host of things we can get into about stablecoins.
Yeah. I mean, I think there needs to be an incentive to hold the assets in those coins that pay some sort of yield, for example, right? So if it's a stable coin and it's invested in treasuries, those treasuries earn a yield. And I know there's a lot of companies that are out there trying to create stable coins to basically capture that yield, to not pay the user and capture that yield. So to me, I think there needs to be and should be some sort of asset or stablecoin that does pay some sort of a yield, so that you are incentivized, right, to somehow over time keep more money in that stablecoin, earn the yield, and then when you need to spend it, you go and spend it. And I think that's one way I think the industry can evolve. I will say that this is, to me, the first shot across the bow of the Visa and MasterCard networks that there's development of alternatives in a real way. But I think there is more work to be done for that to actually come to fruition. What are your thoughts?
I don't necessarily agree with that because certainly there's more work to be done, but the problem here is this bill doesn't extend FDIC insurance. So let's say you want to get your yield from your stable coin, but the company goes under, doesn't matter. Let's say, there's no risk scam protection within this bill. And so I'm saying to you, put it in a money market fund or put it in a high yield savings account that is FDIC insurance. You're getting your 4.2%. You don't have the risk. And then you spend on your credit card. There's so many gaps that they have to fill that I think this bill did absolutely nothing for.
Let's talk about the types of stablecoins that are out there. Now, the most common one is a stablecoin that is collateralized by the US dollar or US dollar denominated assets. So the most common are Tether or True USD. And so you basically get 1-for-1 ratio of the value of the stablecoin and the dollar. And that's very straightforward. And that allows for low or no volatility to cryptocurrencies that are out there, so that if you have a certain amount of Tether, for example, one day, you'll have the same amount the next day. Now, then from there, you get more volatile. And the next would be commodity-backed stablecoins. So the most popular is Tether Gold, and it's cryptocurrency backed by gold reserves. And they say that they have gold reserves in Switzerland, but there are fees according to that. So just to store that, just like there would if you owned a gold-backed ETF and storage there. And then there's crypto collateralized stablecoins. To me, that just sounds a lot like owning cryptocurrency, even though they're over collateralized to some degree, meaning that they have more than $1 in the underlying cryptocurrency. So there's that. And then there's algorithmic stablecoins. This is, to me, where the bigger problems come in when there's some sort of, what was that?
Lunaterra was an algorithmic stablecoin.
Exactly. And that one plunged back in 2022. And because the peg to the US dollar was broken, because Luna slumped more than 80% overnight, which we know these cryptocurrencies can move dramatically. So if the algorithm puts the coin into a cryptocurrency that is very volatile and has a big dip, suddenly that stable coin isn't so stable. So to me, that's where the most risk is. How do you think about these 4 different types of stable coins?
Well, one of the arguments for the benefit to everybody with passing this bill, and certainly I am of the opinion that you do need a regulatory framework for these things. They're going to exist. You should have mechanisms. You should have enforcement mechanisms. But one of the big arguments was, well, the U.S. is in a lot of debt. Thanks to the big, beautiful bill, we're going to be in a lot more debt. The CBO's estimates now up to $3.5 trillion over the next 10 years. And that's only with some of the spending reductions being for a 5-year period. And what happens is you have your treasury-backed stablecoins. And those stablecoins means that there's more treasury demand. And so if you're doing it one-to-one, you have to buy those treasuries. If there's more demand for your debt, well, then you can use cheaper yields, right? You can pay a lower interest because there's all these people that want them. The problem is they're going to be focused on the short end. And as we all know, as listeners of this show, the bigger problem is on the long end of the curve right now being blown out, right? 10, 30 year. That's the big systemic risk there. And that's not really going to do much there, nor can you, as a government that is paying nearly $1 trillion in interest every year, continue to roll over short-term rates without long-term yield curve issues. And so, that I think is probably going to be the most prevalent of the stable coins, the ones that are backed one-to-one by US Treasuries. And so I think that does maybe carry some benefits to it, but there's definitely a lot of uncertainty there as well.
Yeah, definitely. And I think there's some merit to things like commodity-backed cryptocurrencies because, as we know, gold continues to go up and central banks around the world are buying more and more gold. So I think that makes a lot of sense. I think the crypto collateralized stablecoins don't really make a whole lot of sense because just like the algorithmic one, right, where Luna dropped 80% overnight, why can't a crypto backed stablecoin also dropped 80% overnight? So even if it's over collateralized, suddenly it's not overnight. So I think those are the ones that would be very, very risky that I would never touch. Something that I would feel more comfortable with, obviously, are anything that's treasury backed or gold backed or hard asset backed. But the question is more about regulatory framework and whether this bill actually checks all the boxes. I'm a bit skeptical on that.